Right now, you can go online and bet on whether the United States will enter a recession this year. You can bet on interest rates, if the Strait of Hormuz will reopen by the end of the month, even if Jesus Christ will return before 2027. Prediction markets like Kalshi and Polymarket have gone from niche experiments to billion-dollar companies almost overnight. They've gotten so big that CNN is broadcasting live odds from prediction markets on political outcomes. The Wall Street Journal parent company has even partnered with Polymarket, and the Golden Globes showed prediction market probabilities before every commercial break to announce winners. The way these platforms pitch their services to people isn't like a casino, because technically, under federal guidelines, they don't provide gambling services, but they view themselves as a way for the collective wisdom of a market to give predictions on future events instead of relying on single experts. But in reality, the way people are using prediction markets looks a lot like gambling. And that's where you see a lot of people losing a lot of money. The idea behind prediction markets isn't new. It's based on something economists call the wisdom of crowds. The idea that when a large group of people independently estimate something, their collective answer can be more accurate than any single expert. Now, if you add money to the equation, the theory gets even stronger. Because people who are wrong lose money and they stop placing bets, and the people who are right actually make money and probably keep placing bets. Over time, the price is supposed to converge on the true probability. And to be fair, there's real evidence this works. Prediction markets have historically outperformed a large share of opinion polls in elections. During the 2024 election, Polymarket correctly called the outcome while many polls got it wrong. Before Federal Reserve meetings, market prices often come very close to the actual rate decision. Polymarket's CEO went on 60 Minutes and called prediction markets the most accurate thing we have as mankind. But that's the version that gets people in the door to start using these platforms. And it leaves out the part that actually determines whether you can actually make money. So the way that these platforms work are pretty straightforward. You buy shares that pay $1 if an event happens and $0 if it doesn't. So if a share is trading at 35 cents, the market is saying there's a 35% chance that outcome happens. If you think the true probability is higher, you buy. If you're right, you profit. If you're wrong, you lose your stake. Platforms like Kalshi and Polymarket present this as trading, not gambling. You're not placing bets, you're taking positions. And you're not gambling, you're managing a portfolio. And that framing matters because in a traditional market, you're buying something with underlying value. You're buying a company that generates revenue, it produces cash flow, and it exists independently out of the market's opinion. SpaceX is a good example of this. SpaceX is a company that doesn't trade on the stock exchange, but it's still a legitimate company. And if you were to put SpaceX on the stock market, yes, you can buy shares in it, but outside of the stock market, it still exists. In prediction markets, nothing outside of the market exists. You're just buying a binary outcome. There's no underlying asset, there's no cash flow, there's no intrinsic value. The only thing that determines whether you win or lose is whether someone else is willing to take the other side. So when one person wins, another loses the exact same amount, minus fees. Because remember, the platform always takes a cut. And even though some of these platforms, like Kalshi, will frame themselves in a way where their goal is to show accurate predictions on economic data, 87% of Kalshi's trading volume in March 2026 came from sports contracts. Not macroeconomic forecasts, not geopolitical analysis, sports. 40% of overall prediction market volume reportedly comes from novelty and entertainment markets. Stuff like how many tweets someone will post, which celebrity will do what, or which team will win a game on any given night. And even though people like me or you would just place bets trying to make some money on what we feel will happen, on the other side of those trades are professionals. They're basically market makers running quantitative models, and their goal isn't to predict the future better than you, it's to profit from how you trade. They capture the spread, they profit from volume, and they make money whether you're right or wrong. Basically, your trades are their liquidity. And then there's the information or insider trading gap. In early 2026, a trader on Polymarket placed a large bet that Venezuelan President Nicolas Maduro would be removed from power. Days later, the US military captured him and the trade paid out over $400,000. Before the Iran strikes in February 2026, Polymarket saw a sharp spike in purchases of contracts predicting exactly that outcome, and it was placed by accounts that appeared to have advanced knowledge. The CFTC issued a formal advisory on insider trading and prediction markets. Congress published a legal analysis and multiple bills that have already addressed it. And you have to understand that prediction markets, they don't have the same level of surveillance or enforcement that traditional financial markets do. They don't have things like the SEC, and insider trading in these markets exists in a much more ambiguous space. And in a lot of cases, it's never really prosecuted. That means if you're a retail participant, you're not just betting on the future, you're potentially trading against people who have access to information that you don't have. And if you think the odds are on your side that you'll make money, you're wrong. Retail loss rates on prediction markets are estimated between 85 and 90%. That's on par with some of the highest risk trading products out there. And yet, these platforms don't carry any of those kinds of warnings. Because you have to understand, the way people lose isn't random. It's behavioral, it's overconfidence, it's people thinking reading the news gives them an edge when it doesn't, because they're still trading on the same information as everyone else. It's things like recency bias screwing people over, because if the last data point was strong, people assume the next one will be too. And one of the biggest drivers in losses in these platforms is FOMO. And the platform design reinforces all of this. Everything looks like investing. There's very clean interfaces, portfolio views, financial language. It feels like strategy. But underneath is just gambling. And I think that's one of the biggest reasons people get addicted to prediction markets. Because in a casino, when you lose money, you blame the casino or the house. But in prediction markets, it doesn't feel like there's a house. These platforms are positioned as peer-to-peer. But the house is still there. It's the fees taken on every trade. It's the market makers capturing the spread. It's the more sophisticated players with better models and faster execution. It's people who have access to info you don't. The house isn't a single entity. It's the entire system you're trading inside. People who advocate for prediction markets, they always love to talk about how accurate they are compared to other things like polls or anything else. But they typically fail to mention that at the end of the day, whoever has the most capital can greatly influence the odds of something. For example, if 1,000 people each put in $1 for thing A to happen, but one person puts $3,000 for thing B to happen, the market would show that B is more likely to happen, even if the general group consensus was that A should happen. And during the 2024 election, we saw something like that. Because a single French trader reportedly moved Polymarket's presidential odds by several percentage points through massive directional bets. And whether that person had some insider info or was simply wealthy and opinionated is still debated. But what's not debated is that a single participant was able to move the price that millions of people were interpreting as probability. So on thinly traded markets or a niche political race, the wisdom of crowds effects breaks down because a handful of traders with strong opinions and a lot of capital can dominate the price regardless of whether those opinions are correct. Prediction markets work best when they have large numbers of diverse, independent participants trading on well-defined outcomes with no insider advantage. And that describes maybe 5 to 10% of the markets currently listed. The other 95% are some combination of thin, speculative, sentiment-driven, or insider knowledge outcomes, and those are the markets absorbing the vast majority of retail volume. And look, at the end of the day, I'm not against people gambling, and I don't want the government to ban it or anything, because this is America. You can do what you want. And if you're an adult and you want to gamble, maybe I don't think it's a good use of your money, but it's your life. And prediction markets, they are a real innovation. When the conditions are right and there's deep liquidity, diverse participation, clearly defined outcomes, they can accurately predict information in ways that polls and individual experts can't. And that counts for something. And the people who build and advocate for these platforms are correct that there's genuine value in a mechanism that forces people to put money behind their beliefs rather than giving opinions for free. But I just want you guys to understand, the system has winners and losers, and the distribution isn't random. Market makers capture the spread, insiders trade on information you don't have, platforms collect fees on every transaction, and the retail participant, the person watching CNN, seeing a probability and thinking they have some special read, they're funding the entire ecosystem. Prediction markets aren't wrong, but they're not what most people think they are. And for the majority of participants, they function as gambling against better informed players who make money off you losing money.